Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. As promised, I am coming to you with a bunch of information about, well, you. This is actually really cool. I really enjoyed this stats as I read them. This is put out by Batch Data. Batch Data is the Q2 2025 Investor Pulse. And they are a data provider. Really cool. This is all about investors. So institutional investors, small, medium-sized investors, investors in general. Okay. All right. This first stat we all should be helping everyone understand. Investors aren't necessarily competing with traditional home buyers. Investors purchased an average of 455,000 homes in Q2, well above the national average of, well below the national average of 512,000. They targeted lower priced older homes in need of work rather than the move-in ready houses most families buy. A second point, which is another thing that I think people believe that is not necessarily true. Wall Street isn't the dominant force. Now, this is important because now we're talking about you guys. Over 90% of investor-owned homes belong to small landlords with fewer than 11 properties. Mega investors with 1,000 plus homes control just 2.1% of the inventory. See, now that makes me super excited. I love the fact that all of us control more of the inventory. It's just really, really cool to me. And that's a stat that just is not ever really talked about. You guys, me, all of us, we own the majority. We're the dominant force. Not Wall Street. Wall Street's just started to figure out this is a good deal. Investors are returning inventory to the market. This is another thing that's not talked about. 60% of investor sales went to traditional home buyers. So investors buy, and then investors sell. And when investors sell, there's not selling to other institutions. Largely, they're selling back to the market. That's what we do because typically that's where you're going to get the best price for your property. Small investors are net buyers, but large institutions have been retreating for 6 quarters. This isn't 2008 era speculation. That's another thing that keeps being brought up. Most investors are long-term holders, adding much-needed rental supply and renovating older homes. Institutional players increasingly pivot, deploying capital into build-to-rent projects, adding inventory rather than competing with traditional home buyers for existing inventory. This is just simply not happening at scale, that there's this huge competition with homeowner buyers. Most of the build-to-rent communities that are being built purposefully for rental properties out of the gate. People aren't coming in and just going, oh, hey, I think I'm going to buy this whole neighborhood that's already built and I'm going to buy it out from underneath all of the homeowners here. This is not what is happening. So 33% of all home purchases in Q2 2025, the highest in at least 5 years, were investor. But this surge reflects not a flood of investor activity, but the vacuum left by retreating families as affordability eroded under sustained high mortgage rates. Sorry, those are not high. 6.7 is not high throughout the quarter. And actually, we really ought to stop saying that. 6% interest rates are not high, folks. They're higher than we had for a decade, but they're not high. So I don't believe we're going back to 3% interest rates. I just don't believe that's going to happen. So for what it's worth. I've said it. Let's talk about the macros here for just a second that are shaping this. Mortgage rate shock. Now, it was a shock. That's actually a true statement. 6.7% average rates effectively priced out over 50% of traditional middle-income households while leaving cash-rich investors unaffected. True statement. First-time buyers collapse. Participation dropped to just 24%, an 8% point decline from 2023 in first-time home buyers. Six-figure incomes are now required in over half of U.S. markets, with nearly 60% of households unable to afford a $300,000 home. And I can also state, in most markets, it is almost impossible to build a home for $300,000. So, in large part, they don't exist anyway, for what it's worth. Large investors pulled back for the sixth consecutive quarter, demonstrating sophisticated risk management rather than market abandonment. And it really depends on what you like. Their model initially doesn't work in this market. So they have to retreat and they have to come back with a different strategy, because their initial strategy to buy everything and overpay for it because appreciation is just going to take care of them long term. Well, you can't continuously overpay for properties. No, I don't think that actually works long term. So there's no wonder that they're rebooting a little bit. Some other really cool stuff in here I wanted to get to. Listen to this. This is really good. The macroeconomic disruption has positioned investors as critical market stabilizers rather than competitive threats. Again, totally agree with this. With 60% of investor purchases made in cash, they provide essential transaction volume when financing constraints paralyze traditional buyers. Without this investor participation, many markets would face severe illiquidity and potentially destabilizing price volatility. I 100% agree with that. It talks a lot about targeted markets, specifically like tourism market strategies, Hawaii, Alaska, Montana, Maine, places like this where right now on short-term rentals and things like that, you can get decent cap rates. However, I have been seeing a lot of chatter that the Airbnb market is kind of becoming what happened to Turo, in that, and Turo was the car rental market, where it became oversaturated and it didn't work as well. A lot of markets, it's becoming oversaturated because people are buying an enormous amount of these. West Virginia, Mississippi, Arkansas, these states enable volume-based strategies. Why? Well, because the prices are cheap, $147,000 to $183,000, creating immediate positive cash flow while building portfolio scale rapidly. Yep. I found this interesting. The percentage of investor-owned homes by state: Maine, Montana, Alaska, and Hawaii are roughly 30%, which is really high. Of the nation's 86 million single-family homes and townhomes, 17 million, or just under 20%, are investor-owned. Not sure if you knew that or not. We need those properties for people who either can't or don't want to own so that they have a place to live. Really, really important. So highest investor shares: Maine, Montana, Alaska, Hawaii. I just said roughly between all of those, 30%. Lowest shares: Minnesota, Colorado, Connecticut, all hovering around 10%. So about half of the national average, and a third higher for the other guys, right? Interesting statistics. I would have never guessed. I would have guessed maybe Hawaii, but I didn't. I would have never thrown Alaska in there. That's an interesting one. Montana and Maine, both vacation destinations, and I guess Alaska is too. I just never would have thought about it. That's interesting. This is also interesting. Small investors, which we talked about, own overwhelmingly the majority. Okay. Despite headlines about Wall Street, small investors continue to comprise the majority of the property market, representing robust entrepreneurial activity rather than institutional dominance. 87% of all of the homes owned are 1 to 5 homes, right? So people who own 1 to 5 rental properties is 87% of the market. 6 to 10, 3.9, 11 to 50, 4.5, 51 to 100, 1. 100 to 1,000, 1.6. 1,001 plus, 2%. It's amazing. So of that 17 million, 14.5 million properties are owned by people who own between 1 and 5 houses. Really, really, I feel that's really, really cool. And why? Because it's the greatest tool to build generational wealth. And this is proof that people are out there making it happen. So good for you guys. Everybody listening who falls into one of those 2 or 3 first categories, that is literally 87 plus 4 months. Well over. It's 90, I would say, small investors. So if you're under 100 homes, 100 homes or under, which I would consider small to medium-sized investors, that is literally 3.6. That is literally 96.4% of the market. 96.4% of the market. That's insane. It's an insane number. And it's a great number for the country. So next time you hear about Wall Street owning everything, not true. And one more point. Next time you hear them suggesting that we should limit people's ability to own properties, just remember that the vast majority of properties are owned by you. Don't fall into the trap of thinking that it's cool to regulate people on the number of properties they can own. If you own 4 right now and you think it's uncool for someone to own 96, give it a few years. You'll be surprised at how quickly that number can move. And then you fall into the category of a quote unquote large investor. Don't fall into this trap. 2020 to 2023, 18.5% of it was the investor share during normal market conditions. 2024 was 25.7%, because remember in 2024, the pressure started to mount, right, on regular homeowners. In Q2 of 2025, 33%. Okay. So you can see we've almost doubled the amount of the average normal market conditions to today. So I think that's actually pretty cool too. There are some phenomenal deals happening, especially with builders right now. So it doesn't shock me that people are taking advantage of those. This is interesting. For the 6th straight quarter, mega investors demonstrated what appears to be a strategic market withdrawal, purchasing 4,069 homes and selling 5,800 homes, which was a net disposition of 1,731 homes. So they've lowered their inventory by 1,731 homes. So they're still buying, but they're selling more than they're buying. That actually makes sense too, because when they started buying, they bought at ridiculous low compared to the market today. So they're taking some chips off the table, which makes total sense. The cool thing is they're not just selling and leaving the market. They're selling and they're moving back into the market. In a lot of these cases, they're moving up. Large institutions are rotating capital into build-to-rent developments rather than competing in existing home markets. So if you remember, they first started coming in the market, they were buying everything they could get their hands on. Old properties, big packages of old properties, REO properties. REO is real estate owned by a bank that then foreclosed on. They were buying anything and everything. Now they're selling a lot of that stock and they're moving up. It's not unlike what happens, like we've been teaching for years and years and years, a couple of decades. What do? You start where you can, and then you ultimately start moving up, right? You get nicer homes. They don't cost you as much money. They're easier to own long term because they're new. There's just not that much that goes wrong with them. That's literally what Wall Street is doing. And it's easier for them to control and to buy build-to-rent communities than it is to go buy onesie, twosie properties all over the place. So this creates an opportunity for small investors. Why? Well, the institutional retreat makes it so that more nimble investors who can execute on value-add strategies with greater operational flexibility. So that means if they're pulling out of that market, there's more opportunity in that market, which for rehabbers and people in that particular business, it means there's going to be more inventory for them. I mean, look, you make money in any market. That's the reality. I think we've been saying that on this show for, well, how long have we been in this? I don't know how long we've been doing the show. 3 years, 4 years? I don't really know. I should know that, but I don't. I don't think that the pricing really makes that much difference. Shocker, they're paying a little bit less than market. They're becoming more disciplined in their acquisition standards. They had to, the large folks. Institutional investors, when they first started, were not very disciplined in their attack of the market. Although, understandably, they didn't have to be at that point because there was so much runway ahead of us with appreciation that they took advantage of. The pattern of investor-to-investor transactions demonstrates shifting market dynamics. Large investors, 45 to 50% of purchases and 57% of sales involve other investors. So this is interesting because there is a market that I think most people, unless you're in the business, don't know. And that is that large institutional investors sell to other large institutional investors a lot. That's what that just said. Now, all investors, 13% of purchases are from other investors and 40% of sales involve other investors. That makes more sense to me, right? So the average investor, or 90%, 96% of the market, they're not buying from other investors. They're buying from the market. And 40% of those sales, because they're already investment properties, are being sold to other investors. Also makes total sense. The rest of this is a regurgitation of everything we just talked about. So anyway, this is a fantastic report. I really enjoyed reading this. I've got another one I'll do another show on from the property management world, which will give a little bit different take because it's from the world of property management. And I'll probably do that show next or maybe in 2 shows. I don't want to get too statistic heavy, like 2 weeks in a row, but this was such a great report. Very, very interesting. I hope that those statistics give you some idea of what's happening in the market because it underscored a lot of things that I've been talking about on the show. A couple of other things I'm going to try to look up for you guys. There's been some pretty cool things happening in the larger technology market that I'm going to bring to you guys in the next few weeks. So stay tuned for that. And remember, just like I said last show, it is time. It is time. If you've been waiting all year to buy a property, the wait needs to end and you need to really start looking. Otherwise, you're not going to get one this year and you're going to have to wait till next year. All right. So with that in mind and armed with all of the information about the market, till next time, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.